It started like a normal Friday move until silver hit 67, and everything underneath the market tensed up like a tripwire just snapped. Because $67 isn't just a price, it's a pressure point. On the surface, you see a metal rallying. Under the surface, you've got contracts stacked on contracts. Futures, options, swaps, tied together by one fragile promise. Collateral will be there when the market demands it. And when silver jumps hard into the weekend, that promise gets tested fast. Margin calls don't wait for Monday. Liquidity doesn't care about your narrative. Someone has to post cash, metal, or both right now, or positions get cut. Here's the unsettling question. What happens when the people who can't meet those calls aren't day traders, but institutions? That's why traders whisper, kill switch. Not because an exchange flips a dramatic button, but because the system has a way of turning a crowded bet into a forced exit. Overnight, by tightening the financial oxygen. So if you're wondering why a spike in silver could even touch banks, the answer isn't in the jewelry shop. It's in the plumbing, and the plumbing just started shaking. Number 1, the origins of the silver trap. Long before silver became the headline-grabbing metal of 2025, it was quietly woven into the foundation of global finance. What most people don't realize is that silver's story isn't just about shiny coins or industrial demand, it's about how money itself evolved. For centuries, silver was the working man's gold, a parallel currency that gave governments flexibility and gave banks leverage. When nations abandoned the silver standard, they didn't abandon silver's financial influence. They simply buried it inside a deeper layer of the system: futures markets, derivatives, and collateral chains. Silver transformed from physical wealth into a paper instrument that could be multiplied thousands of times over. That transformation meant the market became small in substance but enormous in exposure. Every ounce began to represent a promise, and every promise was tied to a balance sheet. By the time the modern commodities era took shape, silver had become a quiet stress indicator for the entire financial ecosystem. Its volatility wasn't just speculation, it mirrored liquidity cycles. When credit expanded, silver slept. When credit tightened, silver woke up violently. Traders on Wall Street began to call it the mirror metal because it reflected fear faster than almost any other asset. During the 2008 financial crisis, silver collapsed alongside stocks. But when the Fed unleashed quantitative easing, it was one of the first assets to rebound. That rebound wasn't random. It was a signal. Cheap money fuels risk appetite, and silver thrives in that environment. But the inverse is also true. When liquidity dries up, leveraged silver positions implode first. This made it an unspoken diagnostic tool for stress in the system, one that few people outside commodities ever noticed. Now, as central banks around the world struggle with inflation, shrinking reserves, and rising distrust, silver has stepped back into its historical role as both warning and weapon. A metal once dismissed as outdated is now being used as a hedge against the credibility of fiat money itself. When it breached the $60 range, it wasn't just a rally. It was the market calling the bluff of global debt stability. Every uptick forced banks, brokers, and clearinghouses to recalculate their collateral exposure. The 67 mark became more than a number. It became a line between control and chaos. That's why analysts whisper about the trigger, because silver, in all its overlooked brilliance, is once again reminding the financial world that even small markets can bring giants to their knees. Number 2, the chain reaction that built the $67 shock. The story of how we reached the $67 silver trigger begins years before the first headline ever mentioned it. For over a decade, low interest rates and massive money creation quietly rewired how commodities were financed. Banks discovered they could generate huge profits by rehypothecating metal contracts, using the same physical silver as collateral for multiple loans. That worked as long as prices moved slowly. But every system built on leverage has a pressure point, and silver's volatility made it the perfect fault line. As institutional investors and industrial buyers both competed for supply, banks filled the gap with paper silver, contracts promising future delivery that outnumbered physical ounces by ratios as high as 100 to 1. The structure looked efficient on spreadsheets. In reality, it created a fragile ecosystem where a fast price surge could trigger cascading collateral demands overnight. When silver began its steep climb toward the mid-60s, traders at major clearinghouses started flagging discrepancies in pledged collateral. Some banks were posting the same metal through multiple derivative chains. Others had lent out their hedges entirely. By the time silver touched 67, margin departments across several exchanges were in emergency calls. That's the moment referred to as the Friday kill switch. It wasn't a literal button. It was an automatic response coded into risk systems that instantly tightened credit terms. Borrowing costs for leveraged positions spiked. Overnight repo rates jumped. Clients were told to post more cash or close trades. The effect was brutal. Forced liquidations hit smaller funds first, But the losses rolled uphill into prime brokers and eventually the banks that financed them. Within 48 hours, liquidity in certain silver-linked contracts had vanished. And what began as a commodity rally now looked like a miniature credit crunch. Behind the scenes, treasury desks scrambled to assess exposure. Some banks quietly reduced lending against metals collateral altogether, fearing further contagion. That move had unintended consequences. By cutting credit lines, they inadvertently worsened the squeeze, forcing even more liquidations as traders rushed to raise cash. The cycle fed on itself until Friday's close. When markets reopened Monday, the damage was visible. Shattered spreads, suspended funds, and whispers of counterparties facing undisclosed losses. Analysts called it a microcrisis, but it revealed a deeper flaw. The global financial system remains hypersensitive to shocks in assets once considered minor. Silver, a metal with a market smaller than many single tech stocks, had just demonstrated how thin the walls between commodities and banking really are. Number 3, the hidden mechanics behind the collapse. The real danger in the 67 trigger wasn't the price of silver itself. It was how deeply that price was embedded in financial machinery that few outsiders understand. Every major bank and hedge fund operates through layers of derivative contracts, collateralized lending, and cross-margining agreements. When silver's surge shocked the system, it wasn't just traders getting margin called. Clearinghouses demanded extra cash from banks, who then passed that pressure downstream to their clients. Those clients, often managing multi-billion-dollar portfolios, were forced to liquidate unrelated assets just to stay solvent. The crisis wasn't visible on the surface because it didn't start with a headline failure. It started with spreadsheets, liquidity models, and overnight repo contracts quietly going red. Inside those risk engines, small errors multiply fast. One broken hedge in the silver market can ripple into foreign exchange desks, interest rate swaps, and short-term funding markets before anyone can slow it down. The mechanics of this collapse echoed what economists call collateral contagion. Modern finance doesn't rely on gold bars or vaults full of cash. It relies on high-quality assets, treasuries, metals, even warehouse receipts, to back every transaction. When the value of those assets swings too sharply, the chain of promises starts to wobble. That's exactly what happened during the silver shock. As the price exploded, the paper contracts diverged from the physical market, creating an arbitrage gap that dealers couldn't easily close. Banks that once saw silver as a low-risk hedge suddenly found their exposures ballooning because the underlying collateral was being repriced hourly. Meanwhile, investors who had borrowed against those same contracts discovered that their leverage ratios had inverted. They owed more than their collateral was worth. The result was a silent run on liquidity disguised as market volatility. By Monday morning, the financial press called it a technical dislocation. Behind that polite phrase was a network of institutions scrambling to keep funding lines open. Some trading desks halted metals lending altogether, while others sought emergency support from central banks' standing repo facilities. It wasn't a meltdown on the scale of 2008, but it was a warning, a glimpse into how fragile the post-pandemic financial structure has become. The $67 threshold didn't break the banking system, but it revealed how easily it could be broken. The moment silver stopped being a simple commodity and became a systemic signal, every trader understood what that meant. The next crisis won't announce itself with a crash. It'll start with collateral and end with confidence. Number 4, the banking dominoes begin to fall. When the silver market convulsed around the 67 mark, few outside the trading floors realized how quickly its shockwaves would hit the broader financial system. The first domino was the funding desk, those invisible departments that ensure every trade, from a billion-dollar bond to a minor commodity position, stays financed overnight. As silver's volatility spiked, risk models flagged the entire precious metals complex as high variance collateral. That single designation had consequences. Banks began marking down the value of silver-backed loans, which forced clients to either post more collateral or face liquidation. The adjustment rippled outward, hitting metals refiners, logistics companies, and hedge funds holding cross-collateralized positions. Suddenly, a single ounce of silver wasn't just a metal. It was the spark igniting a network of margin calls. Behind every recalculated exposure lay the same cold question: who can't pay by Monday? The contagion spread further through derivatives markets. Credit default swaps linked to commodity finance firms widened overnight, signaling growing doubt about counterparties' solvency. Treasury desks hoarded cash, and interbank lending rates nudged upward for the first time in months. Analysts watching the screen saw familiar red flags: funding spreads widening, repo rates tightening, and short-term liquidity evaporating. It was the same anatomy seen in past crises, only smaller in scale and faster in speed. Regulators quietly contacted major clearinghouses for data, fearing a repeat of the 2022 nickel fiasco. Some banks began unwinding positions across other commodities. not because of losses there, but to offset the capital now trapped in silver-linked accounts. That forced selling bled into unrelated markets like copper and energy futures, pulling down prices and spooking investors who didn't even trade precious metals. The more institutions tried to contain risk, the more correlated their failures became. By midweek, headlines framed it as market turbulence, but insiders recognized the pattern. Confidence was eroding. Central banks faced an uncomfortable decision, whether to step in with liquidity backstops or let the market cleanse itself. They opted for silence, watching to see if the system would stabilize. But silence in markets is rarely calming. It breeds rumor. Traders whispered that one European bank had frozen collateral redemptions, while another had quietly sought overnight funding from a central facility. Whether true or not, perception became reality. The 67 silver trigger had revealed what policymakers preferred to ignore. The world S financial system isn't T built on metal or money. It's built on belief. And belief, once shaken, moves faster than any price chart ever could. Number 5, the aftershock. When confidence turns into contagion. Once the immediate panic faded, markets tried to normalize, but the damage was already embedded in the system. The Friday surge to $67 had exposed how fragile the global credit network truly was. Over the next several days, liquidity evaporated in places that had nothing to do with metals. Small and mid-sized banks began reporting temporary technical delays in settling interbank transactions. Those bland phrases hid a deeper problem. Institutions were hoarding capital, afraid that their counterparties might be sitting on undisclosed metals losses. The phenomenon mirrored early stages of every modern crisis, when institutions stop lending not because they are broke, but because they no longer believe anyone else is solvent. It's the financial equivalent of a crowd hesitating before a fire alarm, 1 second of doubt before the stampede begins. That hesitation alone was enough to tighten credit conditions across Europe and North America. Corporate borrowers felt the shift almost instantly. Overnight lending rates crept upward, and commercial paper markets froze for certain commodity-linked firms. Industrial manufacturers reliant on silver for electronics and solar components found themselves caught in a paradox. Their raw material costs were skyrocketing while their credit lines were shrinking. Some companies resorted to offloading inventories at discounts just to raise cash. Meanwhile, investors searching for safety flooded into U.S. Treasuries, pushing yields down even as central banks debated intervention. The silver shock had mutated into a confidence crisis, not because balance sheets had collapsed, but because everyone feared the next unknown exposure. This dynamic exposed how intertwined commodities, credit, and perception truly are. A small market can ignite systemic fear faster than any policy can contain it. Regulators scrambled to craft narratives that sounded reassuring but didn't commit to action. Press conferences described transitory volatility, a phrase now synonymous with denial. Behind closed doors, risk committees quietly raised collateral haircuts across multiple asset classes, making borrowing more expensive just when liquidity was needed most. It was a classic self-inflicted contraction. Policies designed to restore order instead squeezed the system tighter. As markets steadied superficially, insiders knew the calm was deceptive. Silver S-climb wasn't part of the problem anymore. It was the signal that global finance had reached a new level of fragility. The 67 trigger became shorthand for the moment faith cracked. What began as a technical rally in a niche metal ended as a global rehearsal for the next crisis, one not of losses, but of belief. Number 6, the new order of precious collateral. By the time markets steadied weeks after the $67 silver event, the damage had already reshaped how institutions think about risk. Silver had proven that a niche commodity could destabilize trillion-dollar systems built on leverage. Central banks, regulators, and trading houses convened emergency forums to reassess collateral eligibility. Behind those diplomatic phrases lay a quiet revolution. Some clearinghouses began limiting how much silver exposure could be pledged for credit. Others demanded full cash margins for positions once financed at 10-1 leverage. Overnight, silver transformed from a cheap source of collateral into a liability. Traders who once viewed it as a low-risk inflation hedge now treated it like nitroglycerin, profitable but dangerous to hold. The old model of infinite rehypothecation was finished. Markets learned that collateral could no longer be multiplied endlessly without consequence, and that realization sent tremors through every asset class built on similar assumptions. The financial world also discovered something deeper. Trust had a price. Banks that had once moved liquidity seamlessly between desks began hoarding reserves. Counterparties demanded proof of physical backing for metals exposure. Custodians quietly audited vaults, revealing small mismatches that once went unnoticed but now triggered alarm. Even after prices retreated from their peak, the psychological scar remained. Investors began shifting from paper silver into allocated holdings, draining liquidity from the futures market. and further tightening credit availability. This feedback loop created a strange paradox. Each attempt to make the system safer also made it more rigid. With fewer intermediaries willing to lend against silver, volatility remained permanently elevated. What was once a financial lubricant had become a stress barometer that flashed red at the first sign of tension. The 67 trigger ultimately redefined what it meant for a commodity to be systemic. Silver's surge exposed that the world's debt architecture depends on stable collateral, not just central bank policy. When that collateral moves too fast, the gears grind. Governments now face a dilemma. Either re-engineer markets to withstand such shocks or accept that periodic convulsions are the cost of modern finance. Analysts still debate whether silver's rise was manipulation, panic, or inevitability. But one fact is undisputed. The metal forced the global system to reveal its weakest link. What began as a Friday price spike became a case study in how easily the illusion of control can evaporate. In the quiet aftermath, silver stands, gleaming, not as treasure, but as a mirror reflecting the fragility of the financial world that tried to tame it. What the $67 trigger really meant. The reason the 67 kill switch felt so terrifying wasn't because silver is the center of the financial universe. It's because silver is small enough to move violently, yet connected enough to tug on the same collateral ropes that hold up much larger markets. Once price accelerated into that zone, the story stopped being about metal and started being about who could fund their promises and who couldn't. If you remember one thing from this entire timeline, make it this. Modern crises rarely begin with a single collapse. They begin when liquidity becomes conditional, when lenders, clearinghouses, and counterparties quietly decide the world is riskier than they thought and demand more cash for the same exposure. That's how a price chart turns into a balance sheet event. 3 takeaways you can use immediately. The real trigger isn't a number, it's speed. Fast moves force margin calls, and margin calls force selling. That chain is mechanical, not emotional. Collateral is the hidden heartbeat of finance. When collateral gets repriced aggressively, funding tightens everywhere, even in markets that look unrelated. Confidence breaks before institutions do. Rumors, widening spreads, and sudden credit tightening can create a crisis atmosphere long before any headline failure appears. The warning. If silver stays elevated or makes another sharp leap, watch for the quiet signals. Tighter lending terms, higher haircuts, volatility spikes in funding markets, and sudden risk-off selling across assets that shouldn't be connected. Those are the footprints of stress moving through the system. And the open question is the one that should bother everyone. If a relatively small market like silver can shake the plumbing this hard, what happens when the next shock hits something much bigger? If you want, I'll make the next video a practical guide. The exact indicators to track weekly, the key reports, and the warning signs that show whether this stays contained or spreads. Drop silver in the comments so I know you want that breakdown. And subscribe, because the next trigger won't announce itself politely.